Hi, this is Jim Cunningham. We're going to talk about Prop 19, what homeowners should know. And we're recording this in 2025. In the summer of 2025, Prop 19 passed in 2020. There's been a lot that's happened in the last 5 years since Prop 19's passage. And the Board of Equalization has come out with clearer guidance. There was a big letter that came out last year, in December of last year, to give us more guidance. And there's a lot of good stuff in here. And there's something really good if you are going to leave your home to a child or you've inherited a property from your parents. You really want to pay attention to this because this is an opportunity to save about $10,000 or more per year in property tax. And there's even a way to move that tax base to another property. So we're going to talk about that. That's if you're the child. So property, this is very important. We're going to talk about Prop 19 at the beginning of this video. A lot of black letter law. So what that means is the law that's in the books, that's in the California Constitution. We're going to go over that. I'm going to give you my commentary so you understand that because it's very technical. And then we're going to go into examples toward the middle. And then at the end, we're going to go through a lot of what you need to know, like what is a change in ownership? What is assessment? What is reassessment? We explain that in the second half. A lot of people who watch these videos have watched many videos, so I think people want to see the new stuff. But if you're kind of confused as you go through the materials, just hang in there because we're going to explain what a lot of these terms are, and hopefully it'll give you more understanding so that you can go and rewatch the video and really learn. Like that's the point of here. There are only a few exemptions from reassessment in California. When property changes hands, that's and death is a change in ownership. So mom dies, maybe dad's passed away, mom passes away. That mom's date of death is the change in ownership. It's not when the property is distributed to you as a beneficiary of a trust or an estate. Prop 19 gives homeowners the right to move their valuable tax base, your valuable Prop 13 taxes, your low Prop 13 taxes to a replacement property. Prop 19 passed in 2020. It eliminated the parent-to-child reassessment exclusion, and now they call it the intergenerational transfer exclusion. Two separate exclusions. If you inherited property before February 15, 2020, you're under a different set of laws versus after February 15, 2020. This can lead, by the way, when property gets reassessed, and we'll have some examples, this can lead to a doubling, a 10xing or a 20xing of property taxes. It depends on how long ago that property was purchased, right? Maybe your mom or dad bought that property a long, long, long time ago, and that property's gone up in value. Maybe they've had it 60 years, right? That's how we get these big numbers. And I would say many people are blindsided by the realities that California's property tax system. They don't know. They get hit with the supplemental tax bill, and now they can't afford to hold that property. So very, very important for many people. If you're watching this on YouTube, please subscribe to our YouTube channel. We drop new content pretty much every Thursday at 6 p.m. And I'm Jim Cunningham. I'm a partner at Cunningham Legal. I have been an attorney over 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law. I'm also a real estate broker, securities insurance licensed, and a pilot single-engine land instrument rated, although I am not current. A lot of hours in a Cherokee 6. These are the attorneys in our firm. We are dedicated to all things peaceful transfer of wealth from one generation to the next. And that includes business owners, that includes people who own real estate portfolios, or just someone who has a house, right? And an IRA, let's say. We're there to help them as well. Our languages that are spoken by our attorneys, we obviously all speak English, but we also cover many other languages: Armenian, Cantonese, French, Korean, Italian, Mandarin, Russian, Spanish, and Ukrainian. And we have people who are native speakers of all of these languages. So it's very important. California has a lot of different kind of people living here. So if this is you, just know that we do have that capability. Disclaimer, very important. I'm a lawyer. I'm talking. This is not legal advice. When I say you, there is no attorney-client relationship. This is information only, and hopefully it's a little bit of fun. Why should you care about Prop 19? Well, Prop 19, we're going to unpack the law. On November 3rd, 2020, big election, California voters approved Prop 19, which modified the California Constitution. It took away your ability to leave or transfer property to your children and largely avoid reassessment. What we are talking about is not capital gains taxes that you pay to the state government or the federal government. We're talking about the property taxes that you pay to one of the 58 county assessors each year, right? We pay a lot of taxes in this country. And what we're talking about is this one that you pay twice a year to the county assessor, not the one you pay, quarterly to the state or federal government or annually to the state or federal government. So what is property tax? What is reassessment? And these are some real examples from Zillow. This is just to give you an idea. This is a Los Angeles property. 2023 assessed value was $35,000. There was a change in ownership. That assessment went to $850. The taxes went from $624 a year to $10,477. Real world example, up 1,600%. This is why this is very, very important this is a very, very important property right. So if you sold that property, maybe sold it for $850 and you moved from LA County up to Sonoma and you bought a property for $850 and you're just paying the new $10,000 taxes in Sonoma, you're not going to get retrospective relief. You'll get prospective relief. So if this is you may be leaving a lot of money on the table. Here's an example from San Rafael in Marin County. $4,400 assessed value. Change in ownership. Assessed value goes from $201,000 to $693. Taxes go up 133%. Another one in Sacramento on G Street on the grid, not too far from the state capitol. Assessed value in 2015 of $1 million. And then in 2016, it looks like there was this isn't making sense. 374 in 2014, and then the assessed value jumped to $1,030,000. So the taxes went from $4,500 to almost $12,000. And here's on C Street in Sacramento. So this is the Thrifty 30s for those of you who are familiar with Sacramento. Again, assessed value $100,000, change in ownership in 2019. The assessed value jumps to $433 because there's this change in ownership, higher taxes. So what should homeowners know about how property tax works in California? Property tax is based on the assessed value of real estate, which is determined by the county assessor. We have 58 counties and 58 county assessors. If you're watching this on YouTube, there's a little GIF of a person trying to herd cats or kittens. Property taxes are billed annually or semi-annually. Typically, they're paid in two installments. A lot of people just pay it in one. But they're paid to the county tax collector, and property is taxed at 1% of its assessed value and can only increase 2% per year. So if you are contemplating a move from New Jersey to California, and in the last couple of years, New Jersey has been the number one place that people have moved from when moving to California, your taxes may be different. You may be paying 3% a year in tax. Whatever it is, in California, just know that it's limited by 1% per year. Sometimes the taxes are higher than 1%. That's if it's approved by 2/3 of voters. They can add some taxes, but the California Constitution limits the baseline property tax to 1%. So Jane purchases a home in Los Angeles for $500,000 under Prop 13. The assessed value is set at the purchase price of $500,000. The property tax, the Prop 13 taxes are 1%, plus there's some local taxes of 0.25%. So the initial property tax bill is $500,000 times 1.25%, and that's why it's $6,250 and not $5,000, even though I'm saying property is taxed at 1%. Each year, that can only go up 2%. If that property doubles in value in 1 year, let's just say hypothetically it did, your property taxes won't double. That is not the case in a lot of other states. A lot of other states, the local municipalities or counties or states can raise taxes if they have a budget shortfall. So what are property taxes used for? Here's an example of where the property tax goes in Marin County. This is from one of their publications. It goes 14% to counties, 12% to cities, 53% to schools. So property tax largely funds California public education, and then 20% to special districts. The property tax in California raised more than $89 billion with a B for local government during 2022 to 2023. And it's a lot of money. So it's a very large source of revenue for the state and its little agencies. So California pays very close attention to this. And, if you think you can pull one over pull the wool over their eyes, think again. So what is the difference between assessed value and market value? Historically, over the last 40 years, California real estate has increased at about a little over 6% a year on average. Increase in market value. Taxes since 1978 have been limited to a 2% per year increase. So You'll have a delta, and this graph shows 1995 to 2012, kind of ignoring the last 13 years. But the line on the top shows as this market value goes up, your assessed value goes up incrementally. Now, certainly, if there's a sale, in our example here in 2002, that's when the taxes stepped up on that particular property because there was a change in ownership, there was a sale of the property, or maybe the death of a property owner, or change in ownership if it was held by an LLC. There's a California property tax calculator, and this is on smart assets. So if you're looking to how much are these taxes going to be in California, you can go, and we have a link in the notes here on the YouTube page. The death of a family member can have a big tax consequence. Death is a change in ownership. This is very, very important to understand. A lot of people, when somebody dies, we talk about change in ownership. They think, well, that's when I get the property, right? Or it's when the property's sold in the estate. No, it's when the person dies. So sale, it's pretty obvious. You sign a deed and you close escrow. There's a sale. Gift, kind of obvious, right? It's when you give, you sign the deed and you have it recorded and deliver it to the person who's receiving the property, or death. And death is the real gotcha. Also a change in control in an entity like an LLC. This can cost thousands, if not tens of thousands of dollars in additional property taxes. And the problem is you're going to get a supplemental unsecured property tax bill. So you may be administering an estate and mom dies, and let's say you sell the property, no one moves in it, and you hold the property for 8 months. You're going to get a supplemental unsecured bill for that 8-month time period, but you may not get it for like 11 months after you tell them that mom has passed away. So if mom passes away and you don't bother to tell them for 7 months, then you sell the property, you may be getting a bill 18 months after your mom's passed away. That is an unsecured bill, which means the trustee or executor is personally liable for that. And if you've already distributed the assets to the heirs, there is no legal recourse to recover money from the people that have received their inheritance unless they sign what is called a refunding agreement to give you money back. So a little wrinkle on that. If you're trying to settle a trust yourself and there's real property involved, I'd check with the lawyer, and that's something we could certainly help you with. Okay. Yeah, if property gets reassessed, it can make it unaffordable for heirs. So we covered that one. So Jane purchases a home in LA for $120,000 in 1985, keeps the property for 40 years. Before passing away in 2025, leaving it to Kevin, her son. The fair market value is $1.2 million and the assessed value is $263,000. Now you might think, wait a minute. This property is worth $1.2 million and the assessed value is $263,000. That's not fair to all the other taxpayers who buy the property at $1.2 million. Look, I'm not saying it's fair or it's not fair. That's just the way it is. Okay. That number is the $120,000 plus 2% a year. So the property tax is about $3,300 a year. It's reassessed when it's passed down to Kevin. Let's say Kevin says, I am not going back to LA. That is not going to happen. I'm in Sonoma. I love it. And I'm not picking on LA. I'm just saying, Kevin says, I'm not going to go down there. His taxes are going to jump from $3,300 to $15,000 a year. Now, if Kevin chooses to live in the property, then he can mitigate a good chunk of that, if not all of it, right? Because the property's worth $1.2 million. The assessed value is $263,000. If Kevin chooses to move into that property and make it his home, then his taxes stay at $3,300. Thereafter, Kevin can sell that property and buy a replacement property and transfer his tax base, maybe in Sonoma, and then rent it out. So he moves there, it's his home, and maybe a couple years later moves out and then rents it out. So remember that Q&A from the letter to assessors from 2024. Big deal. And this is all about planning. And, if you quantify this, if you think about this, what are we talking about here? Jim, you're saving $10,000 a year. It's just not, $10,000 isn't what it used to be. Let's say you hold a home you keep a home for 30 years. The net present value of saving $10,000 a year is about $190,000. So it's a lot of money, right? That's a net present value. So brief understanding of key property tax laws, Proposition 13 and 19. So Prop 13, the old rule everyone loves, 2% cap on property tax increases. So for those of you who lived in California, for those of you who say California, Prop 13 is a ripoff, you should talk to people who owned property in the 1970s. The average the average tax rate was like 2.6% on property, and property was going up at a really fast clip in the 1970s. And so people's property tax bills kept going up and up and up, and people didn't like it. So they voted. There was a tax revolt. Howard Jarvis Taxpayers Association led the tax revolt in 1978, limited property taxes to 1% of the property's assessed value at the time of purchase, and a 2% increase every year. This provides stability and predictability for property owners. And this, in an era where there is less stability and less predictability, having predictable property taxes, at least there's one thing that's predictable in California, is the property taxes. So this is the new rule everyone hates, Prop 19. Well, except if you're going to transfer your tax base, I guess it's good. But if you're inheriting property from your parents, you're not going to like it. So this was passed in 2020. Prop 19 eliminated the parent-to-child reassessment exclusion, gave us the intergenerational transfer exemption, and that is capped at $1 million of assessed value coupon. You can think of it, and we'll have an example in here in a couple of slides. So transfers to children and grandchildren, they lose their reassessment protections under Prop 13. There's still the family home exemption, which we've been talking about, but with a cap. We will discuss a little bit the family farm exemption. There are a few other strategies, not exemptions, that we can use, and we've kind of been talking about that. But reassessment's triggered when there is a change in ownership. So change in ownership is a big one. Not all counties handle Prop 19 the same way. So this is like the Board of Equalization with the counties, trying to keep them herded. Their counties are different sizes. They're all not little kittens. While the Board of Equalization attempts to herd all the 58 cats in the same direction, it varies by county on how these rules are interpreted and applied. So pay attention to this. There's a Board of Equalization letters and regulations. So we've got one from 2021, 2022, 2024. I really encourage you to take a look at those, see if they apply to you. Very, very important. There's a unified series of California forms. They're the BOE, that stands for Board of Equalization. 19 stands for Prop 19. P is in Papa, B is in Bravo. P is the parent-to-child reassessment exclusion, or the intergenerational transfer exclusion. B is the base year transfer. So if you're going to move your base year, so if I sell my home and I buy another one, I'm going to use the BOE 19B. There's this 3-year claim window that we've talked about, the homeowner's exemption requirement, and there's a biennial adjustment of the $1 million cap. This is if you're inheriting property from a parent. So if your parent dies before 2023, it's $1 million. If your parent dies February 16 to February 23 to February 15 of 2025, you get a coupon of $1,022,000, and that bumps up to $1,044,000 for deaths February 16, 2025 to 27. Same rule book, different referees. Prop 19 is a California state law, but counties don't always play by the same playbook. This is something you need to understand. So we will ask you, if you reach out to us, hey, I've got this issue going on. We're going to ask you for your property tax bills. We're going to know what county the property is located in. Although the rules are uniform, the interpretation and enforcement varies widely. So they're not just calling balls and strikes, but they've got their own spin on it. These main differences are fees. Some counties charge fees, others don't. Speed. Is it going to take 3 weeks, or is it going to take 3 years? Is the assessor going to say, or the tax collector assessor's going to say, just go ahead and pay your tax bill and you'll get a refund in 2 or 3 years? That happened to one of our clients on a very expensive property, a multifamily property. So they're having to front several $100,000s a year on property taxes. And the assessor says, yeah, we'll give you a refund in a year or two. So go figure. That was Orange County. Documentation requirements. So how do you prove that you're living in a home? If it's a parent-to-child transfer, how do you prove that? Well, each county's different. Strict adherence versus relaxed adherence. Some of them are a little more on it, and others are not as much on it. So the universal requirements are you have to, if this is a parent-to-child transfer, you absolutely have to make that residence your home within a year. So within a year of the change of ownership, and if mom passes away, that's the date of the change of ownership, you got to move in within a year. You're going to file the homeowner's exemption or the disabled veterans exemption within a year. That's the best approach. and continued occupancy to maintain the exclusion. So you're going to have to live in that property. If you later rent the property out, you're going to lose it. Now, where do the counties differ? Documentation required as to proof. Is it driver's license, voter registration, utility bills, number of verification documents, 2 to 5, depending on 5 verification documents. So if you go, well, gee, I'm just paying my PG&E bill or my SCE bill online and voter registration, I can't find that thing. And okay, I've got my driver's license. You're going to have to get some other ID together and pay attention to that. Aggressiveness in monitoring continued occupancy, right? So if you say, I'm living in that property and then 2 years later you rent it out, are they going to, are you going to get caught? Right? I'm not condoning it. I'm not suggesting you lie. In fact, I'm suggesting that telling you to tell the truth. You don't want to commit tax fraud, but there are varying degrees of aggressiveness in monitoring the continued occupancy and the speed of reassessment if your requirements aren't maintained. That's a little question mark. So San Francisco typically requires more extensive documentation than most counties, while LA and San Bernardino have clear guidelines but varying enforcement practices. So it's going to depend county by county. So the fees, counties have discretion to charge processing fees of up to $175 with their Board of Supervisors approval. Santa Clara charges $110 for certain Prop 19 transactions, and many counties charge no fee at all. So again, if you submit a form right up against the deadline and don't have your fee, that form's rejected. So has it been accepted or not? This is why you need to pay attention to the rules, because if you're coming in, 11 months and 29 days and you're doing that filing, you want to make sure that you've got everything that you need so that they accept that form. Otherwise, you're going to miss out on a tax benefit. Large counties such as LA, Orange, and Riverside County often face significant backlogs in the months, measured in the months. And believe it or not, we're still in a little bit of that COVID backup. Smaller counties typically are much shorter. We measure that in weeks. What about ADUs? So counties agree that only the actual family home unit qualifies under Prop 19 intergenerational transfers, but different documentation and methods for apportioning value. So Butte County explicitly includes ADUs as part of the primary residence for portability tax calculations, while other counties may be less clear. There's clarity on transferring your tax base if you're 55 or over or the victim of a natural disaster or wildfire. But if there's an ADU on your property, less clear. Okay. So very important to pay attention to this. How do appeals work? I will say, broadly speaking, if you get a notice of assessment or notice of reassessment, you typically have a very narrow window of time to challenge that. And by, typically it's 60 days, but 60 days from the date that they mail you something. Now, I don't know about you, but how often do you check your mail now? So you really need to pay attention to this. Counties have different responses when homeowners exemptions denials affect Prop 19 eligibility. When the homeowners or disabled veterans exemption is denied and it's affecting your Prop 19 claim, some go to an assessment appeals board, some need court intervention, and some don't have clear next steps. So I hope you don't get there, and there's not a whole lot of case law. I hope you don't get there, and that's why it's important to have all of your stuff, all of your information in a form that the assessor wants to see, so that they go, yeah, hey, here you go. Here's your tax benefit. Taxpayer experience. I can say it varies wildly. Santa Clara, San Francisco, and Sacramento offer detailed explanations, examples, charts. Many counties provide absolute minimal information beyond the Board of Equalization forms. I mean, some of these counties have thousands of people while others have millions of people in them, right? So their budget's different. Some, but not all counties have guidelines, interactive calculators for value comparison worksheets. Some of the larger counties. And so if you're in a smaller county, go on one of the bigger counties just to get an idea and educate yourself. Inflation adjustment charts for the $1 million cap that we mentioned. Detailed FAQs on county-specific practices. Again, Board of Equalization, 5 members of the Board of Equalization. They're in charge of the 58 assessors. That's one of their roles. And to make sure that the laws are equally applied, hence the term the Board of Equalization. And step-by-step filing guides with county contact information. So If you need to contact them, that is generally available online. Again, some of these, if you pick up the phone and call the Mono County assessor, it's maybe the tax collector and the dog catcher, and Sierra County has 2,500 people in it. It just depends on the county that you're dealing with. So key takeaways and action items, I would say the reality check, administrative differences create a real patchwork of implementation of Prop 19 across California's 58 counties. To have a successful outcome, I think requires county-specific knowledge of the procedures, documentation requirements, and administrative tendencies, not just the Board of Equalization regulations. I would say in our firm, we are very well versed in the large counties. Certainly, I think a lawyer who's competent in this area of practice, probably well versed in the counties in which they practice. We happen to practice in most of the big counties in California. We're very well versed. The smaller ones, we may not know, because that maybe, if you're dealing with a property in Sierra County, we may only deal with that once a year. Again, population 2,500. Strategic planning, plan for Prop 19 transfers well in advance. This is really important, and have an attorney with an experience with Prop 19 in your corner. Certainly that would be us. And I would say, especially with in the smaller counties, you're probably going to need the attorney help more than you will in the larger counties. Now we're going to go over some technical things for people who might want to take a deeper dive into what are the terms that we're using. So we're going to talk about what is a change in ownership. And you know what I think I'll do? I'm going to answer some questions here. Beginning April 1, 2021, and there are different dates in here, which was very confusing when this passed. But beginning April 1, 2021, an owner of a primary residence, this means it's your home, where you're eligible for the homeowner's exemption. If you're 55 years or over, severely disabled, not just disabled, 25% of Californians live with a disability, but not all are severely disabled, or a victim of a wildfire or natural disaster, you can transfer your tax base from the property you're selling to a new property, a replacement property. So if your home is worth $1 million and your assessed value is $200,000 and you're over age 55, you can sell that home for $1 million, buy a replacement home for $1 million, and you're not paying $10,000 a year property taxes. You're going to keep paying $2,000 a year property taxes. So that's really, really good news. And this is anywhere in California. This is inside the county. And this is to if you're in one county and any of the other 57 counties. A homeowner can transfer, and I'm going to throw some technical language at you, I apologize, the factored base year value. Basically, this is what we would call assessed value. So assessed value is this value that changes, that goes up 2% every year, and we'll cover this later in the video, how this works. But basically, if you look at the number on your tax bill, right, at that, you can take that to a replacement property if all the following conditions are met. Now, this is not just meet some of them, almost all of them. At least the sale of the original property or the replacement property must occur on or after April 1, 2021. Well, we're in 2025, so we can check that box because, 2021 is years ago. As of the date of sale, well, actually, though, if you're looking at this and you go, I heard I could transfer my tax base and I sold my property in 2021 and I bought another property in 2022, pay attention because you may still be able to get relief. Now, it'll be prospective. You're not going to get a refund, but you might be able to cut your tax bill going forward. Now, if I went through that too quickly, understand, if you sold a property and bought another one and you qualify here and you just got reassessed on your property, you may be entitled to cut your tax bill. So if this is an aha moment for you, or you say, gee, I know someone who could benefit from this, share this video and have them watch it, right? As of the date of sale, of the original property, the claimant is at least 55 years old, severely and permanently disabled, fairly high bar, or a victim of a wildfire or natural disaster. And this is very important, there are no age requirements for people who are severely and permanently disabled or victims of a wildfire or natural disaster. So you're 55 years old or older and your house, you're not a victim of a wildfire, you're not disabled, you can do it. But if you're the victim of a wildfire, natural disaster, or severely and permanently disabled, then you do not have to be 55. So for those people, maybe they were in the Palisades, maybe they were in Altadena. And if you're one of those people, I really feel for you. Many of our clients lost their homes, were otherwise, even if you didn't lose your home, It's very traumatic, damaging to your health, a whole host of things. Those people pay attention to this because you have the opportunity to move your tax base. So very, very important. You don't have to be 55 for that. As a result of its sale, the original property must be subject to reappraisal at its current full cash value. So what that means is if you sell your home, that home has to get reassessed. So if you say, hey, I'm going to give this home to my kid, it doesn't work. It has to be a sale and it has to be fully reassessed. So if you transfer, maybe you sell your home to your child and you allow the child to pick up that parent to child reassessment exclusion, which is a requirement. You have to let them. Then you're not able to transfer your tax base. So very, very important. So as a result of the sale, the original property must either be subject to reappraisal or receive a base year value determined in accordance with these disaster reliefs. So meaning if somebody buys your property, and here's the other part of this, if you're 55 and over and you sell your property to someone who is the victim of a wildfire or a natural disaster and they buy your property, but it's not fully reassessed, you still get to take your property tax benefit with you. So let me say this another way. When I say your property must be fully reassessed, that's broadly speaking, it's true. It must be fully reassessed unless someone else's exemption lets them get a lower property tax. So whether that's a child or just a third party. So it's very important to understand you can't transfer it to the child and pick up that benefit and take your property taxes with you. So very common question that clients have. So another requirement, the original property must be eligible for the homeowner's exemption or the disabled veterans exemption. If you are a 100% disabled veteran and you are not getting your disabled veterans exemption, I really encourage you to take a look at that because it cuts your property taxes, cuts your assessed value a few $100,000. It's significant savings. The property must be eligible for the homeowner's exemption. This is very important. A lot of people don't know to check the homeowner's exemption box. So you have to be eligible. That box doesn't necessarily have to be checked. Little nuance there. But that's a result as your ownership and occupation, or meaning living at the property as your primary residence. So it must be your primary residence. This is very, very important. If you've checked the homeowner's exemption and it's not your primary residence, you are not eligible for the homeowner's exemption. If you've moved someplace else, if you've rented the property out, for example, and you go, I'm going to just check the homeowner's exemption, but I'm renting it out and I'm going to sell it and I'm going to game the system. That's tax fraud. You can't do that. So you have to be eligible for the homeowner's exemption, meaning it has to be your home at the time the property was sold, within 2 years of the purchase or new construction of the replacement dwelling, or just prior to the date the original property was substantially damaged. So what that means is you're living in the property when it was sold, and then if you sell your home and build your dream home, you have 2 years to build that home from the date of sale of your property to the date that the certificate of occupancy, because that is construction, that's when it's finished, when you can lawfully occupy the property. And here's a warning. We have a neighbor in Northern California. It took them 3 years to get a building permit in Marin County. 3 years. That's more than 2 years, right? It's not rocket science math here. So that would be a situation where you might want to do some planning. If you are building your dream home, you may want to start construction of that dream home so that the sale of your existing home and the certificate of occupancy on your replacement home are within that 2-year window. So it's going to require some planning, some thought. You can certainly buy or build that property ahead of time and then move your tax base after the sale of your relinquished that home that you're living in. So if this is very confusing and I'm throwing a lot at you, we're going to have some examples later in the video. Now, this is another one. Just prior to the date that the original property was substantially damaged or destroyed, that is going to be the value that you take. So let's say you have a home in the Palisades that was worth $5 million. That home is destroyed in a fire and you sell your lot for $2 million. You're able to buy a replacement residence for $5 million and transfer your tax base. Okay, so that's what that provision means. By the way, this comes straight from a letter to the assessors, and we'll have a link in the materials here. The replacement dwelling. So you relinquished your property. Now your replacement dwelling is purchased or newly constructed within 2 years, and this is before or after the sale. So within that 2-year window. The replacement dwelling must be eligible for the homeowners or disabled veterans exemption as a result of the claimant's ownership. So your ownership and occupation or living in the property, meaning you sell the property you're living in and you got to move into that property and be eligible for the homeowners exemption. That's very important. So if you're not living there, if you're renting the property, or if you keep both properties for 3 years, you're not going to be able to do this. Okay. So it's very, very important. A claim must be filed with the county assessor of the county where the replacement property is located. So it's a form where the replacement property is located. So if you sell your LA County home and build your Sonoma County dream home, that form will be filed with Sonoma County, not Los Angeles County. The claim must be filed within 3 years of what? The claim must be filed within the claim for tax relief must be filed within 3 years of the date the replacement dwelling was purchased or the new construction was completed. So you sell one property and within a 2-year period, either before or after, you have 3 years from that date to file the form. If this is all confusing to you, we help out a lot of people. They go, Jim, this is too complicated. It's too important. I'm selling my $5 million house. I'm buying another $5 million house. Our assessed value is $1 million. I don't want to get reassessed for $40,000 a year every year going forward. I need help with this. Please reach out to us. If that number is 100,000 and 500, reach out to us, but any number, and we're happy to help out. If all the requirements are met, but a claim is filed after the 3 years. Now, this is very important. So if you're watching this and go, snap, I sold my house in 2020. I bought a replacement house in 2022, and here it is 2025 or 2027 or 2030. Boy, am I missing out on stuff. You can file after the 3-year period and get prospective relief. Now, you're not going to get a refund for the extra taxes you paid. Sorry, but as a resident of the state of California, thank you. You're not going to get relief, but retrospective relief. You will get prospective relief. Again, very valuable. I mean, this is a free webinar. How great is this? I probably will have saved somebody tens of thousands of dollars by pointing this out who's watched this video. If I've saved you money, please put a comment in our notes here in the comments on YouTube. So we have an example. So if this is all Jim, wow, this is really complicated. If a claim is late filed in 2020, relief will apply as of the lien date, January 1 for the 2025-26 fiscal year. So here's how this works. By January 1, 2025, the fiscal year runs July of 25 to June of 26. Basically, the assessor collects all the information, and there's this, the lien date is January 1, where the assessor says, okay, this is who owns the property. We're going to calculate the property tax bills. We're going to send all that information to the tax collector. Tax collector has 6 months to get the bills out for that year, and then you get your bill. So there's no refund or cancellation of taxes for years prior to the year that the claim is filed, right? So we're recording this in August of 2025, so you wouldn't get relief from 2024. But if a claim is filed after the assessment roll is closed, and that's July to December 31, then that roll will need to be corrected and taxes refunded. So if you file in August of 2025, you're going to get some benefit in 2025, partial benefit in 2025. In 2026, you're going to get the full benefit. So if this is all like hard to follow, just understand that if you've sold one California property and bought another California property, and those are your residences, and you meet one of these criteria, you're 55 and over, victim of a wildfire, natural disaster, or severely and permanently disabled, you may be leaving a lot of money on the table for not having filed this form. So please share this information. So there's a value comparison test. So you might say, well, okay, you buy a property of the same, of equal or lesser value. What if you buy a property that's more, right? What if you sell your $1 million place and you buy one for $2 million? What happens? Well, we're going to find out. The transfer of the tax year with no value there's no value adjustment, meaning your taxes don't go up, then the replacement dwelling must be of equal or lesser value. If you sell a property valued, it sells for $1 million, maybe the assessed value is $100,000, but that value sells for $1 million, and you buy a replacement property for $800,000, your assessed value is going to be $100,000, same assessed value. You're not getting a benefit. They're not going to give you a little benefit and cut your taxes. Not going to happen. But if you go over that $1 million, then you pay the difference. So a replacement dwelling of equal or lesser value does not change the taxes, But to the extent, if you have $1 million home with an assessed value of 100,000, and then you buy a $1.1 million home, you're going to add that 100,000 to the other 100,000. So your assessed value becomes 200,000. Meaning, if you buy a home of equal or lesser value, no change in your tax. If you buy your replacement home before you sell your home. So again, let's example of moving from LA to Sonoma County. If you buy your Sonoma County home first and then you sell your Los Angeles home to move to Sonoma County, then it's 100%. So if you sell one property for $1 million and buy another for $1 million, your property taxes don't change. If you sell your LA County home and then buy your Sonoma County home, it's 105% of the value. So you could buy a home for $1,050,000 and your taxes wouldn't change. And if it's a year after that, so if you buy a replacement property between 1 and 2 years after you sell your original property, you can pay 1.1 million for a replacement property and not have a change in taxes. So I would say this isn't this is just a benefit. I would say this I have not seen this drive decisions in the real world, but it's a little bit of a benefit to taxpayers. So then again, what happens if it goes beyond that amount? Then that's added. And that was the example I gave. If you sell your home for $1 million and buy another one for $2 million, your assessed value is going to increase by $1 million, right? So the difference gets added to your tax base, which is think of that as your assessed value. What about multi-unit dwellings? So many communities in California have multi-unit dwellings. So if you live in a duplex, how does that work? If you live in a 4-unit, a 4-unit apartment building in the larger cities in California, many people live in multifamily dwellings. So each unit of a multi-unit dwelling is considered a separate primary residence. So a duplex would be 2, a fourplex would be 4. A single-family residence that has an accessory dwelling unit, also known as ADU, or junior accessory dwelling unit, JADU, is not considered a multi-unit dwelling if all of the following are met. Now, we're going to get into how the individual counties do this differently. So it's a bit like herding cats. The Board of Equalization has to herd 58 counties, and there's these 58 kittens out there that the Board of Equalization needs to keep in line. So if you have a single family home and there is a dwelling unit on the property, and the only other units on the real property are ADUs or JADUs, so there's not something that's not an ADU, right, which would be maybe a duplex. Any ADUs and JADUs are not separately alienable, meaning cannot be sold. And there was this change in the law where if you build an ADU, you can basically sell off the ADU. Well, if you do that, it's not going to qualify for this. It'll be deemed a multifamily. So that ADU stays with that primary residence kind of for the duration. And the claimant occupies one of the structures as their primary residence. So what could you do? You could be renting out the main house and live in the ADU, and then sell that property and transfer your tax base. So pretty cool, right? Pretty cool. Or you can live in the main house. All right, so let us move on to wildfire or natural disaster. I'm a California native. The first fire I remember was in 1984 in Ojai, and it was a very scary fire and big, huge firestorm. So for those of you who have lived through that, I feel it, and it is not a good thing to go through. And it's something that unfortunately we live with in the Western United States. And now we're seeing it in Canada and the Eastern United States as well. So go figure. If the original property was substantially damaged, which is more than half, or destroyed by wildfire or natural disaster and sold in its damaged state, I am not encouraging you to sell it in its damaged state. There are a lot of tax issues potentially with that. We're just going to set that aside. All we're talking about is property tax. I mean, there's some income and capital gains tax issues with that and collecting insurance proceeds. But if it is sold in its damaged state, and the example I gave is a Palisades home, maybe it's $5 million, burns to the ground, you sell the lot for $2 million, you can move your tax base to a new property, to a $5 million property, even though you sell that one for $2 million. Okay, so the full cash value is determined by the value immediately preceding the wildlife or natural disaster. I'm not quite sure how they do that. Maybe it's an appraisal. I don't know, but that's kind of interesting. A natural disaster is a disaster for which the governor proclaimed a state of emergency, such as a fire, flood, drought, storm, mudslide, earthquake, civil disorder, foreign invasion, or volcanic eruption. Now, this is what if the governor declares it, not the president, and that's been in the press here recently, some of these proclamations. So this is where the governor declares it. A wildfire means an unplanned, unwanted wildland fire, including unauthorized human-caused fires, escaped wildland fire use events, escaped prescribed fire, so if they're brush clearing and it gets away from them, and all other wildland fires where the objective is to extinguish the fire. This does not include your house burning down, right? If there's an electrical fire and your house burns down, you're not covered. Well, I suppose unless you're 55. Please note that wildfire does not require the proclamation of a state of emergency. And a lot of times these wildfires have a name, so they get named. I'm not quite sure. I would just take that definition of wildfire. If your home has been damaged by a wildfire and you're not quite sure, that's something where you could certainly engage the services of our firm to help you with that. Limitation on number of times you can do this on base year transfer. How many times you can do this? Each person can utilize their base year transfer 3 times. So you can do this now. I'm past age 55. I don't know that I have it in me to move 3 more times, certainly my house. But, you could use this 3 times if you're single, up to 6 times if you're married. So if you're married and you have 6 children and you want to transfer, and you have 6 properties and you would like to transfer these properties, 1 to each child, actually, we're talking about something else. I'm conflating 2 things, but you can utilize a base year transfer up to 6 times, 3 for each spouse. Again, I don't know who wants to move 6 times. Please note that a disaster base year value transfer does not count toward a person's 3-time limit. So if it's a disaster, that's not counting toward your 3-time limit. So this would be the elective 55 and over type of transfer. Now, let's move to letter to assessor. Let's see here. We're going to move to the letter to assessors 2024-44, meaning this was a letter written in December, happened to be written in December of 2024, the 44th letter from the Board of Equalization to each of the county assessors. There are 58 counties, 58 cats, 1 cat herder, which is the Board of Equalization, which is 5 people. So it's a committee herding the cats. Who qualifies as an eligible disabled claimant? Now, this is really important because 25% of Californians live with a disability, but not everyone is a disabled claimant. So this is a very common question we get. And the answer is the claimant must be severely and permanently disabled. So this is defined in, there are rules related to California property taxes. Rule 462540C14 provides that severely and permanently disabled means any person described under law, which reads any person who has a physical disability or impairment, whether from birth by reason of accident or disease, that results in a functional limitation as to employment or substantially limits one or more major life activities of that person. And that person has been diagnosed as permanently affecting the person's ability to function, including but not limited to any disability or impairment that affects sight, speech, hearing, or the use of any limbs. So if that's you, then you may be entitled to transfer your tax base. Now, this is really important because we're going to learn about something. If you inherit a property from a parent and want to move and potentially rent that property out, we're going to kind of an interesting Q&A in this letter. Question number 5, again, the proof of a severe and permanent disability is required. So you have to prove this to the county assessor. The proof must be in the form of a certification signed by a licensed physician of appropriate specialty, attesting that the claimant, the taxpayer is severely and permanently disabled. And again, although 25% of Californians live with the disability, not all will qualify as being severely and permanently disabled. If this is your child and you are the parent and you are not 55, that you can't use your child's disability to transfer your tax base. So that's one of the questions that we're not going to cover, but we're just covering some of the questions. Okay, this is an important one. A claimant, so this is a person inherited a 25% interest of a home from a parent and then bought the 75% interest from the claimant's siblings. So I inherit a quarter interest in the house and my 3 siblings inherit a quarter interest of the house, and then I buy those 3 siblings out. I do not get tax relief as to that 3/4 because nothing of value is exchanged to receive the real property. So this is the second prong of the purchase is not met. So if you inherit 25% of a residence and buy the other 75% out, then you cannot transfer your tax base. This is the tax base question. Buying out a sibling on a trust is a little complicated. And as I'm reading this in my mind, I may be conflating two things, so I apologize. It's very dense material. But basically, if you are inheriting a 25% interest and then buy the other 75% out, you cannot use your base year transfer. It doesn't work that way. What if a parent, there's another way to do that though, if you're inheriting from a parent that's inheriting a home from a parent, we covered that in another webinar. What if the parent sells the home to a child, allows the child to claim the benefit of the intergenerational transfer exclusion? Does the parent qualify for transferring their tax base? Can the parent transfer? So I have a home, I sell my home to my child, my property is not reassessed. Can I then transfer my tax base to a new home? No, you can't do that. That home must be fully reassessed. And if it's not, then I can't transfer my tax base unless my son was transferring his tax base. Okay. So that would be the exception, which we haven't seen. Okay. Divorce. My spouse and I are divorcing and selling our home. Will each of us qualify for the base year value transfer if we each buy a separate replacement dwelling? The answer is no. Under Property Tax Rule 462520G, only one co-owner can receive the benefit. I love this answer. This is straight from the Board of Equalization. I want you to picture a couple getting a divorce. And then it says, if both of you are eligible, you must decide. They did not say agree, because if you're getting divorced, I don't think anyone's agreeing on anything. You must decide between yourselves, right, who will get the benefit. Only in the case of a multi-unit original property where several co-owners occupy separate units. Now, maybe, the plan there is to sell one property and buy a duplex and one live on one side and one live on the other side, then you do it. I don't know. But basically, if you're getting divorced, only one person can get that benefit, and they're going to have to agree on who gets that. So if that's you and you're getting divorced and both of you want to transfer your tax base, this is something very important to talk to your divorce attorney about. Your divorce attorney probably won't understand this issue. Just have him or her reach out to us and we can walk them through the issues. Question number 15. Okay, this is really important. And this is a very valuable bit of information that you're about to get. It blew my mind when I read it. And this is very favorable to taxpayers. This is pretty dense. So I want to, there's this one and another question and answer on here. I want you to pay very close attention to this. 2 years ago, I inherited a residence from my mother. I filed for and received the parent-child exclusion. In a couple of years after I turned 55, can I sell this property and transfer my mother's base year value to another home that I purchase? The answer is yes, so long as you comply with all the rules. So if you've inherited a property, and what is key here is it says, I received the parent-child exclusion. Now, it did say 2 years ago. The letter was written in 2024. So 2024 minus 2 is 2022. The problem is the parent-child exclusion refers to the pre-Prop 19 law. I am assuming that this has to be some error on the Board of Equalization's part. But when I see parent-child exclusion, that is not the intergenerational exclusion. So they've renamed them different things. So, and this, by the way, this is why lawyers use technical terms or terms of art, is when we use one term of art, we know that we're not talking about something else, right? We can exclude other things. So the answer is yes, as long as you occupy the inherited residence as a principal residence. Once you're 55, you can move that tax base, and the law is silent on how you acquired the property. Now, this is a slightly different, this is question 18. Taxpayer, which you qualify for and claims the intergenerational transfer exclusion. So the other one we were talking about was the pre-2021 law, the pre-February 15, 2020 law, which is the parent-to-child reassessment exclusion. February 15, 2021 and later, the Board of Equalization uses, and the assessors use, different language. It is called the intergenerational transfer exclusion. Now, this is very important, and please listen. So Parent passes away, child inherits the property. This is after February 15, 2021. The assessor establishes the new tax value and the new base year value. 2 years later, so they get it. They get this intergenerational transfer exclusion. So the child gets the property from the parent. Let's say the property taxes don't change. 2 years later, now this is key. 2 years later, the taxpayer sells the original property and purchases a replacement dwelling. Taxpayer meets all of the qualifications for the base year value transfer under the provisions of Section 69.6, meaning they're 55 and over, or wildfire disaster, whatever it is. Which value, the new taxable value adjusted for inflation or the base year value adjusted for inflation, would be utilized for the base year value transfer. So what are we talking about here? Are we using the let's look at the answer. Section 69.6A refers to this base year value transfer as a taxable value transfer. The taxable value is the transfer's factored base year value plus any value that exceeds the applicable value cap. Okay, I understand what they're saying, but here's what's really going on. If you inherit a property that, and we'll see this later in the video, if it's $1,044,000 or less, and that's the current number, basically if it's $1 million or less, there's no change in the taxes. If the difference between the assessed value and the market value when you inherit it is less than $1 million, so if the assessed value is $200,000 and the market value is $1.2 million, you inherit that property valued at $1.2 million, and your property taxes don't change. You then can sell that home for $1.2 million or whatever. You sell it for $1.5 million, buy a replacement residence for $1.5 million. Your taxes aren't going to change. If you buy a replacement residence for $2 million, your taxes are going to go up. That sort of 1% of $500,000 difference. So your taxes will go up $5,000 or so. Now, I know this is taxes and it's kind of dense, but understand that I think this is a very favorable view from the Board of Equalization. So to determine the value to enroll for a base year value transfer, essentially your assessed value, subsequent to an intergenerational transfer exclusion, if the full cash value of the replacement dwelling is of equal or lesser value, so if you sell that property for $1.8 million and replace it for $1.8 million, your taxes don't change. If it goes beyond that, then you are going to pay higher taxes. So here's the kicker. If the full cash value is of greater value, then you're reassessed on the difference. The date, so this is very important. If you inherit a property from your parents, if you inherit the family home in LA, you have to live in that home. You can't rent it out. As I read the answer to question number 18 on the letter to assessors from 2024/044, if you sell that LA home and you move your tax base to a new home in Sonoma County, you can rent that home and you won't get dinged. You won't get reassessed. You won't lose the family home exemption. So let me say that another way, because this is a very common question. People say, I inherit my parents' family home. I inherited the home in LA. I really don't want to live there, right? I'd rather rent it out because I want the rental income. Gosh, because I'm saving so much on the taxes. I'm paying $10,000 less a year in tax. As I read this, the home that you have inherited from your parents, that home in LA, if you rent that out, you lose that reassessment exclusion of up to $10,000. So if the property's valued at assessed value at $200,000 and it's worth $1.2 million, and you inherit that property from your parents and you make it your home, your taxes don't change. If you move out 5 years later, you're going to lose that $1 million assessed value benefit. So your taxes arguably are going to jump $10,000. But if you sell that home and transfer it to a different home, and in this case, Sonoma County, for maybe $1.2 million, it looks like you could rent that home out and you wouldn't lose it. Interesting. Don't go to the bank on that, but this is in the letter to assessors. So as you will see, each county is its own little cat and they do things differently. Question to assessor number 18. Consequently, the new base year value established as of the date of the parent-child transfer plus factoring, you're no longer required to continuously occupy the replacement dwelling. So you inherit that property, you sell it, you move the tax base to a new property. You don't have to live in that property to keep the low taxes. That is the That is the headline from this. So very valuable bit of information. So two nuggets here. Two nuggets. One of the two nuggets is it's a way of getting an inherited property and then transferring that property tax base. Again, if you sell the LA property and buy the Sonoma property, that has to be your residence, the LA property. And then that Sonoma property needs to be your residence. Thereafter, if you rent it out, that's what we're talking about. What is a change in ownership? A change in ownership is a sale. It's Captain Obvious stuff, people. It's not complicated. Gift. Here, I give the property. Death. This is the gotcha. Somebody dies. Revenue and Taxation Code Section 60 defines a change in ownership and must meet a three-pronged test. Transfer a present interest of the real property. A deed. I convey title to Blackacre to A, including the beneficial use thereof. This means the income. If I transfer property to my children and retain the right to live there for my life, or retain the right to income for my life, there's no change in ownership till I die. That is bad planning, by the way. Really bad planning. I'm just giving you an example of what that means. The value of which is substantially equal to the fee interest. Fee comes from Old England to infect property. That's how property was that's how title used to transfer. So you would get a group of people around, and I would grab dirt, and I would take this dirt, and I would press it into the buyer's chest, and I would say, infect this land to you. And there were witnesses, and that's how property was conveyed. We don't do it that way anymore. There is some case law. And so what this means, value which is substantially equal to the fee. If you own a LLC and you lease the property out for 35 years or more, that is a change in ownership. Let me repeat this. If you sign a lease of 35 years or more, if you sign a 20-year lease with 3 5-year extensions, 3 5-year options, that's 35 years. That's a change in ownership. That is reported to the Board of Equalization. Property's reassessed. So be very careful on long-term leases. So owner sells. Owen sells Greenacre to Abel for $1 million. Change in ownership. Owen leases Greenacre to Abel for a term of 20 years with 3 5-year options. Change in ownership. The property's going to get reassessed. Mom gives the family home to a daughter or sells it for $1, right? You can't get around this, right? That's a change in ownership. What homeowners should know, transferring your tax base. So this is a little bit of a recap, giving you an example. Abel, age 60, has a home they purchased in 1995 with an assessed value in Pasadena of $400,000. The market value is $900,000. The current property tax bill is about $400,000. So they purchased it for less than $400,000, but now the assessed value is $400,000. Abel wants to move closer to the grandchildren in San Francisco. So Abel looks at a new home of $1.2 million. Abel transfers his $400,000 assessed value to the new home, files the BOE 19B, transferring the base year value. The new home is $1.2 million in San Francisco. So the new home minus the old home's assessment of $900,000 gives a $300,000 difference. The new assessed value is the old assessed value of $400,000 plus $300,000, which is the difference between the sales price in Pasadena and the purchase price in San Francisco. And the new tax base, the assessed value is now $700,000, right? So the new property tax bill is based on $700,000, not $1.2 million. So the annual taxes are about $7,000 a year instead of $12,000, and this is saving $5,000 a year, whatever the dollar amount. Say $5,000 a year. Now, this is very important. If you are able and you've done this and you didn't know about this, it is not too late to file. You can file this and get prospective relief. You're not going to get your refunds in prior years, but you'll be saving $5,000 a year. So that's, it's better than a gaping hole in your head, right? Rules on transferring property transferring your tax base under Prop 19. There are no change in taxes if you sell one property and buy another property. If you buy another property before you sell your existing property, and that new property is the same value or less, there's no change in your tax. If you sell your property first, then buy another property within a year. So buy another property, that new property can be 105% of the property's value that you sold. And if it's after a year but before 2 years, it's 110%. Any amount above the equal or lesser value is added. So you can purchase a higher value property, but both events must occur within 2 years of each other, within that 2-year window. And there's no requirement that they happen in a specific order. So you don't have to sell one property, then buy another. You can buy one, then sell your property. Co-ownership, this is letter to assessors 2021 slash 19. Can I have a co-owner on title and still qualify to transfer my base year value under Prop 19? Yes. There's no requirement that the homeowner who's over 55 or severely disabled or victim of a wildfire be sole owner on the replacement residence. Now, some can. So an example here is mom sells her Monterey home for 4.5 million with an assessed value of 500,000. Mom buys a replacement property in La Quinta for 4.5 million. Mom goes on title as to 10%. Daughter's on for 90%. Mom dies. The properties may not be reassessed. Because maybe if they're both living there, but some counties, this is why I put this in here. Some counties are taking that position that only mom's portion, only mom's 10% gets relief, and the daughter's 90% does not. Now, of course, unless daughter's selling and transferring her tax base, but this is important. Some counties are taking the position that, well, yeah, your parent can go on title, but they don't get the blanket reassessment exclusion for the whole property. So very, very important. So that's why it's important. If you look at, especially a letter to assessor from 2021, we're recording this in 2025. That's 4 years ago. A lot has happened in 4 years. So if you're going to do a big transaction, it really pays to check in with the lawyer. We're talking here $40,000 a year in property taxes. It's not a small number. So very, very important. Prop 19, parent to child transfers. So when parent transfers their main home to a child, Prop 19, intergenerational transfers, or PNITs, Proposition 19, intergenerational transfer, for those occurring February 16, 2025 through 2027, the first $1,044,586 over the home's assessed value isn't reassessed. And we'll have an example in here. So, but for transfers that happen in 23 to 25, that was $1,022,000. So not too much of a difference. Just understand that if you see different numbers out there, if you're doing research and learning, just know that the different numbers are there is because that gets adjusted every 2 years. So to the extent the market value of the home exceeds the sum of its old assessed value plus this $1,044,000, to the extent it's over that, looking at the market value, the difference is added to the assessment. And this is only for primary residences. A child must make the child's home within 1 year and file forms within 2 years for retrospective relief and within 3 years of prospective relief. If this is a parent-to-child transfer and you file after 3 years, you ain't getting it. That's not going to happen. Now, that's different than if you transfer your own Prop 19 tax base, okay? So different transactions, different rules. I will tell you, this statute was written, well, it was an initiative, horribly written, okay? Just saying. So parent-to-child transfer, child moves into home within a year, and the child should file the BOE 266, which is the homeowner's exemption, and file the form BOE 19P, the intergenerational transfer. So this is the transfer between the old parent-to-child transfer. So it's a transfer from mom to daughter. So the two documents to file. So again, this is a bit of a recap here. You've got to file your homeowner's exemption. And again, the change in ownership has gone up. The $1 million exemption from 21 to 23 became $1,022,000 for transactions in 23 to 25. And now it's at $1,044,586. And there's where it says late filing, okay. This is before February 15, 2021. Different set of rules. Now, if you inherited your parents' property before February 15 of 2021 and haven't done anything, you have a different set of rules, and there's no time limit. Now, you're not necessarily going to get retrospective relief. You'll get prospective relief, so you might have to pay some taxes. But we still do get people who say, mom passed away 10 years ago and I haven't done anything. Well, there's the old rules we'll be dealing with, and we're well-versed in the old as well as the new rules. So the exemption amount, to recap, how does this work? Just rule of thumb, quick math here when we talk to clients. If the assessed value is $900,000, that property is not going to get reassessed because the home is valued at less than your exemption amount of $1,044,000. So if people call us and they say, I'm inheriting my mom's home of $900,000 and I'm really worried, am I going to get reassessed? Well, no, if you move in and you follow all the rules, you're not going to get reassessed. Now, if the assessed value is $600,000 with a date of death value of $1,005,000, you're still not going to get reassessed because we add the $600,000 to the 1,044,000, and as long as that's under $1,500,000, no reassessment. But if the assessed value is 200,000 and the date of that value is 1,544,586,000, that means 300,000 is added to your tax base. So your taxes are going to go up a minimum of 3,000 a year. So that's the difference. So I hope this helps you understand, because the way this has been rolled out and explained is not, I mean, I hope I'm doing a good job, but the way the Board of Equalization has explained this, it's not great. I think they could have explained it 2 or 3 different ways, because sometimes people understand 6 and sometimes people understand a half a dozen. It's just explaining it a different way. So when do you file your 19P, which is the intergenerational transfer exclusion? I don't know why they didn't call it I. I think it's because it was the parent-to-child reassessment exclusion, and it's a parent, but we don't have the parent-to-child reassessment exclusion. It's the intergenerational transfer exclusion. So anyway, BOE 19AH is the is before February 16, 2021. The transferee must file the $175 fee for the homeowners or disabled veterans exemption within a year of the transfer of the within a year of the change of ownership. If it's filed after the 1-year period, it's prospective relief. So mom dies, you got to file this form within a year. If you file it after a year, you're going to get prospective relief. You're not going to get retrospective relief, meaning you're going to pay the higher property tax. Okay. Now, we're talking up to $10,000 or more. It's a lot of money, potentially. It's timely filed if filed within 3 years after the date of purchase or transfer, or prior to the transfer of the real property to a third party, whichever is earlier. So if you, what I'm explaining here is, let's say if you file within 3 years, after a year, but before 3 years, you're going to get prospective relief. You're going to pay the higher taxes for that first year. If you inherit the home, don't file, sell the home in year 2, and then file your parent-to-child your intergenerational transfer exclusion, you're not going to get any relief, because you have to own that property when you file the form. So if you sold the property and you're like, I now got the supplemental tax bill, how do I knock this down? You would have had to have had that filed before the sale. So if it's not been filed within the 3 years, it's timely filed if it's filed within 6 months after the date of mailing of a notice of supplemental or escape assessment issued because the purchase or transfer. I'm not sure this is an old rule. This is going to be the BOE 19AH. This is the pre-2021 transfer. This is not for the 19P. So this last one, it's filed after. So Ashley will want to edit this slide. So how many times can you do this? 3 times. Oh, as many times as you want. How many times can you transfer parent to child? Kind of interesting. This is a letter to assessors from 2021, the 8th letter to the assessors in 2021. So if you have, let's say you have 6 kids and you have 6 homes and you move to one home to the next and you keep giving your homes to your children, you can do it as many times as you like. Prop 19 co-tenancy exclusion. This is a pretty big deal. And this is one workaround. I would say this is one method of having property, avoiding reassessment if the difference between the assessed value and the market value is greater than that $1 million number. So California includes a very narrow exclusion that can prevent reassessment on the death of one co-tenant if 2 co-tenants have occupied 100% of the property together continuously for 1 year before death. The property must have been their principal residence for that year, and the transfer must be solely due to death. This was originally designed for long-term joint ownership situations, which were unmarried couples or unmarried partners. So before marriage equality, when certain classes of people could not get married, the state of California started getting complaints that surviving partners were getting reassessed. And so they passed this law that was effective in 2013. There's a special affidavit that the attorney or the individual can file to pick up this exclusion. But let's look at it from not so much the cohabitating people, not the couples, but let's say a nephew moves into the home to help take care of his aunt, and the home is nephew's residence. Auntie names nephew as joint tenant. There's no reassessment. Or auntie, some gift tax issues there, but no reassessment. Or auntie names nephew as a tenant in common for 1%, resulting in a 1% reassessment. The assessed value is 200,000. The market value is 2 million. Auntie dies and nephew inherits the home. There's no reassessment. This saves 18,000 a year in taxes. I would say this requires artful estate planning, because if auntie wants to settle up with the other nieces and nephews, we got to figure that one out. But if she's going to leave everything to the nephew anyway, might not be a bad idea. Co-tenancy exclusion. So what about other family members? You have to file this affidavit after. What about the kids? Can kids use this? Well, the answer is yes. And we have a real case where two sons, dad owned the home with an assessed value of $500,000 and a fair market value of $5 million. When dad dies, the property taxes will go up $45,000. Dad added son as a 1% co-tenant. Dad owns 99%. Son resided in home with dad. Dad and son were on title for at least 1 year. Son files the appropriate and timely documents with the assessor following dad's death. Dad dies and son gets the $1 million reassessment exclusion on the first million. So the assessed value of 500 plus the next million. And then on the balance of the 3.5 million, the San Francisco assessor gave us the co-tenancy exclusion. Again, this requires artful estate planning. This is a real case. We saved the family $45,000 a year in property tax. Not a bad result. We've done this once in San Francisco County and to conclusion. And I think we have a couple of others that are currently brewing. But if this is you, you can reach out to us and we can help you with that. Let's talk about the family farm reassessment exclusion. A family farm is any real property that is under cultivation or being used for pasture or grazing or to produce any agricultural commodity. And it's all plant and animal products produced in California for commercial purposes. It is a per parcel exemption, so it is not one farm. And I got to tell you, it has to be, there's no gimmicky stuff around this. It's got to be a farm, right? It's got to be real. And a lot of our clients have a lot of ag property. But this is an interesting way to look at this. Ag property in California has different parcel sizes. So meaning we're looking at each parcel of land. If you're a farmer and you own farmland, you need to pay attention to this, right? If you want to keep the property taxes low when you pass away and this property passes to your kids. Mom and dad own a family farm of 8 parcels, 4 acres each of 320 acres. Each parcel is worth $1.1 million. So that's $8.8 million. Each parcel is assessed at $100,000. So 8 parcels assessed at $100,000. There's the total property tax bill is $8,000. That's it, right? That's the total property tax bill. The exemption is $1 million. Well, now it should be $1,044,000 per parcel. These 8 parcels go to the kids because each parcel is worth $1.1 million. Each parcel is worth $1.1 million. That is under when you add the assessed value of $100,000 plus the $1 million exemption as adjusted, comes under that number. There's no reassessment on the 8 parcels. Now, one parcel has a family home and it's treated as a family home because there's a house in the picture here. And so that's treated slightly differently. If there's a home on the parcel that contains the family, it is treated as a family home. And that's how that works. But what if it's a single parcel? What if it's a single 320 acre parcel? Same taxes are paid every year, $800,000 assessed value. The parcel is reassessed at transfer and your taxes go up $70,000 a year. If you're farming 320 acres, you can't afford a $70,000 a year property tax bill. That is going to be a problem. Okay. So, that's something that requires artful estate planning. If you have a 320 acre parcel, maybe we look at subdividing the property if you can into 40 acre units. So maybe we use LLC structures. Maybe we use something else. So I would say if you're a farmer or own farmland, have a family farm, look at your tax bills. Look at how many parcels you have. Pay attention to this stuff. Prop 19 loopholes using LLCs. So loophole, I don't know if if you can call it a loophole. I would just say consider purchasing real estate. It's not a personal use asset like a residence if you don't rent it out. But look at buying real estate with an entity. So farmland, commercial, residential rental property, industrial property. Many times when the owner of the LLC passes away, reassessment can be avoided if the property was originally purchased by the LLC or it was reassessed when it was put into the LLC. Now, part of this is a lot of people who have a property, They're protected by Prop 13. When they create an LLC and transfer the property into that LLC, they don't want to be reassessed because their taxes go up. As long as it's a proportional interest transfer, if I own 100% of the property and I transfer that property into an LLC and I own 100% of those LLC shares, the property is not reassessed. If I own a property and I transfer that property into an LLC, I own 99% of the shares, my son owns 1%, the entire property is reassessed because that is not a proportional interest transfer. The benefit of a non-proportional interest transfer is the property is reassessed. And what we're talking about here is property that, the easier way to think about this is have the LLC acquire the property. So sometimes with strategic planning, we can completely avoid reassessment. But what we're talking about is if the LLC is the original owner. So as long as nobody gets more than 50% or control doesn't change hands, the property's never reassessed. Disney never going to reassess their property. I mean, they're paying ridiculously low property taxes in Anaheim. So when an LLC is not the original owner, so if I transfer a property to an LLC, so long as no more than 50% changes hands and control does not change hands, there's no reassessment. So I would say there's this it depends moment. It could trigger a property tax reassessment despite everyone's best laid options. We have other videos on Prop 19 that cover this, so I would really encourage you to take a look at those. But I can transfer a property to an LLC and then give my son 50%. That is not a change in ownership. So under the laws as they're written. Prop 19, buying out a sibling. If you are buying out a sibling after, let's say you have one sibling and you guys inherit the property and you buy a sibling out, you're going to get reassessed 50%. So let's say the family home transfers to you and your sibling 50-50 and you buy your sibling out, you're going to get reassessed. If the property is, if you buy out your sibling during the trust administration or before distribution from an estate, and there's outside money that comes in, and we work with clients on this, there is a possibility to avoid reassessment. Okay. It's a little heavier lift, a little more complicated. Many trust and estate attorneys don't understand this and they reach out to our firm. So if you're one of those, feel free to reach out. But if you do buy out a sibling, understand that half gets reassessed. So it's like kind of a blended rate. So your taxes go up a little bit, not the full amount. It's not fully reassessed, but the amount that you bought out from siblings. So if I'm one of three and I buy out two siblings, essentially two thirds of the property is reassessed. If I'm buying out three siblings, 75% of the property is reassessed. This assumes that I qualify for the parent-to-child intergenerational transfer exclusion. So keeping it in the estate's usually the best option. Keep it in the trust or the estate and do that buyout, if you will, on the trust or the estate level. This requires planning before distribution, and unfortunately, many people reach out to us after distribution. So, you have to allow, the trust has to permit for non-pro rata distribution, meaning you can, instead of giving the Microsoft stock to, 3 shares, 1 share to each kid, and everyone gets money. One kid can get the 3 shares of the Microsoft stock. One kid can get the property. The other kid can get cash, but it has to be delineated in the trust. So example, mom leaves a trust worth 1.2 million. The house is 900,000 and the investments are 300,000. Alice wants the house, but Bob couldn't care less. He wants the cash. Alice's share is 600,000 or half of 1.2 million. Bob's share is 600. Alice gets the entire $900,000 house. Bob gets the 300 in investments plus 300 cash, not from Alice. This shouldn't be from Alice. It's 300 that comes into the trust by a loan. So maybe Alice is the trustee, but she goes out and borrows the money. So that if you see this on here, that should be $300,000 cash that the trust gets outside, not from Alice. And this all has to be disclosed to the county assessor. They want to see all of this. They want to see your homework. So common Prop 19 mistakes: improperly buying out a sibling, buying property, then putting it into an LLC. You want to buy it with the LLC. Thinking a trust automatically protects you from reassessment. It does not automatically protect you from reassessment. Relying on a CPA or realtor for tax advice. Those are the last people you want to talk to. I mean, they're good people in their own lane, but seriously, people, this is the core of legal: is who owns the property, when did things happen, What are the property tax rules? This is really the purview of trained property tax lawyers like the attorneys at our firm. Not coordinating your legal tax and title strategy, super important. Waiting too long to file forms, missing that deadline, because a lot of these need to be timely filed. Otherwise, you may get no relief or certainly just prospective relief. So key takeaways from today. You can't go back and change the beginning, but you can start where you are and change the ending. I love that quote. Prop 13 is a valuable property right worth protecting. You need to determine your goals. If you say, gee, I really want to save the property taxes, but I really don't want to move into mom's house, you need to think about that and think about what your life goals are. This is not easy stuff. Absolutely not a do-it-yourself project. This is not for a regular lawyer. You need an expert, savvy lawyer to walk you through this. Use of multiple LLCs is risky. We didn't really cover this. We covered it in other webinars. Some people say, well, if I do this transfer and take the property out and put it into another LLC, hey, the assessor, they're wise to that. And I would say approach that with extreme caution. And it is not too late to take action. Bonus, the state controller's property tax postponement program. This is pretty cool. If you are senior, blind, or disabled, you can defer your current property year taxes on your principal residence if certain criteria are met. You are 62 years of age, blind or disabled. Your annual household income is $53,574 or less. The home is your principal place of residence. You have 40% equity in the home, and you do not have a reverse mortgage on the property. You can defer your taxes. They become a lien on the property. And the 2025-26 program timeline is just around the corner. The applications are available September 2025. The filing period opens October 1, 2025, and the filing period closes February 10, 26. This is a limited budget item. I would suggest if this is you, if you're like, I'm watching this video because I make $50,000 a year and I can't afford my property taxes, I'm going to have to sell the house. This program may be for you. And if it's not for you, you may know somebody that this could be for. So very, very important. You need to get this stuff. I would get this application in on the date October 1. I would not wait on this. It's a limited budget item. That's it. We have offices in Northern and Southern California, and we ask that you subscribe to our YouTube channel if you've made it this long to the bitter end. And next up, on August 28th, we have a secret weapon against taxes and creditor threats, trusts. We're going to talk about trust to protect your typically when you pass like creditor protection and tax protection, like why wouldn't somebody like that? Now we're going to open it for questions, and thanks for joining us. And if you're watching this, just keep watching. Another video is going to roll right after this one, and go to our YouTube page or our web page and sign up for a webinar. Thanks for joining us.